Great. Thanks, everyone, and welcome to the next episode of Structured Products Insights. So you have me and Andrew Fox, which you are familiar with. And today we have a very, very special guest, Michael Axelsson, Wealth Manager at Garantum Fund Commission, based in Sweden. We met actually a few months ago. So, Michael, thank you for coming.
Well, thank you for having me.
Now, I know Michael for, I think, more than 10 years. It has always been a pleasure to talk with him. But the one thing that I remember extremely well from Michael is that 8 years ago or 9 years ago, I did try to embarrass him in front of the whole structured products industry. I'm not sure if you remember, Michael, where I pick up one of the worst structured products of the year in terms of performance. And I asked Michael to explain it to more than 300 people. Do you remember that, Michael?
Yeah, very vague memory. I've tried to suppress it. Yeah.
I still remember. It was a structured product, Delta One, so a tracker linked to the MSCI emerging markets, a basket, and it did perform extremely very well in the first 1.5 years, and then the other 1.5 years when the emerging markets start to fall. But I think you did defend quite well because you kind of explained that the client unwinded more than 90%, and they had like a 80% return. And the loss on those remaining 5% that they had, which I think you dealt with it extrememely well. Anyway, hopefully it will happen the same today.
Well, we'll see.
Now, Michael, tell us a bit more about yourself and how you got involved with structured products.
Yeah, well, go back 25 years. I was in investment banking at Merrill Lynch in London. And we wanted to move back to Sweden, and we did. And I wanted to try something completely different. So I went back to my alma mater, which is the Stockholm School of Economics, as a research assistant for a very short while. It was like driving into a wall, coming from investment banking, going to academia. We went from projects lasting 10 days to projects lasting 2 to 5 years. And I quickly realized that I wanted to go back where the action was. Mm-hmm. And as it happened, Merrill Lynch was about to set up distribution of structured products in the Nordics, together with American discount brokerage. So I actually joined E-Trade in Stockholm and helped Merrill Lynch establish distribution of structured products in Sweden and Norway. And yeah, the rest is history. I competed with Garantum for about 6 years until I realized if you can't beat them, join them. So in 2010, I joined Garantum to help them set up Norway, and then I became deputy CEO and eventually CEO. And I think we built a fairly good value proposition for the client. So what I did in 2020, middle of the pandemic, I went back to sales and started meeting clients myself and using all that we had built to give them a good solution. So that's, and now, that's what I'm still doing now for 5 years on.
You mentioned before the recording, right, about your experience with structured products, with other asset classes. I mean, we have a story about that with, the two of us, with many different people in Sweden. But there is something that it will be very, very interesting to know. In your personal view, what has changed on structured products throughout these 25 years? Well, what has been the main changes you've seen in Sweden?
A number of things. I mean, when I started out, everything was capped and protected notes. That's all we knew. That's all we ever sold. And it was like that until the great financial crisis, where interest rates just disappeared and vol absolutely skyrocketed. And you couldn't do capital protection basically with any. I mean, the terms were, and that's when different product types started coming in, and since then it's exploded. There are a huge variety of payoffs out there now, and that's been very beneficial, of course, to be able to move with market conditions, because back then we were extremely dependent on vol being fairly low and interest rates being sufficiently high so that we could put something interesting together. But that's one thing. The other thing is I think when I started out, I was fairly naive, and I thought that derivatives-based products are the answer to every single question ever faced by any investor anywhere. I have a more nuanced view of it now, and I think obviously which payoff you use when and how does matter. And I think a lot. I mean, we've the industry has become much more sophisticated, which is also a very good thing, obviously. But it's changed. 25 years ago, we were still, discovering what this whole industry could be, and now it's matured. And obviously, we've had a lot of influence from regulation. Well, MiFID 2 in 2007, MiFID 1 in 07 and MiFID 2, and PRIPS in 2018, and a number of other things as well. So, it's completely different. It's much more professional and stable now. It was a bit of, the wild, wild west, if you go back 25 years.
Yeah. I still remember those times.
Do you feel like the expectations of investors has evolved a lot in the last 25 years as well? Or do you think it's more kind of bank-led or issuer-led distribution?
I think, the investor community has evolved. Their expectations have changed. I mean, one thing is, my view is that I think that they're much more knowledgeable on average today than they used to be. And then maybe expectations in terms of risk reward haven't changed that much. But if you take things like, what they demand in terms of how we use technology and how we report and the quality of the website. Most people want an app. They want access 24/7. Those things have changed materially, obviously.
I do want to talk about, right? Because you did mention that, in the past you thought that this was solution for everything, but now as a wealth manager, you don't feel that. Can you tell us what are small tricks or the way that you think structured products, how you talk with the investors, your clients, and how do you tell them that they should use the products?
Yeah. Good question. We always do suitability testing, of course, of the client. And if you're going to use and go into structured products, most of them have maturities of 3, 4, 5, perhaps even longer. So you need to be able to, or apart from your capital during that period, obviously. And then what I really like is the non-linearity.
Mm-hmm.
The ability to protect the capital when markets are down, and also, of course, the ability to generate yield or other types of return when markets go sideways or even slightly down. So that's the features that we bring up in the conversation with clients. And now that we've had interest rates back for a while, they're disappearing again now. In Sweden, at least. That's been such a pleasure to talk about capital protection. And, clients can see that, okay, my capital is protected, but in some cases I can even, join in the stock market, the main index, and even get gearing, above 100% participation. That's been a joy to be back in that situation.
Go on, Andrew.
I was going to say, yeah. So you were discussing earlier about the PREP regulation, the MiFID regulation, and SRI coming in. How do you feel that's improved decision making on your side and on the investor side?
So, PRIP and SRI we're talking about, yes.
Yeah.
First of all, the intention is praiseworthy, to say the least. What we're trying to do is take all the factors that impact an investment decision, put them all in one document, and make that document comparable across all product types. It's a fantastic idea. Now, I am on record for saying that PRIPS is the most counterproductive legislation ever to come out of Brussels because no one uses it and it's very confusing and misleading.
Mm-hmm.
But still, the ambition is good, and I hope we can continue to work on that document to make it more useful. Right now, I don't know of anyone who would seriously consider using the KID as the only information for an investment decision. We know the scenario analysis is flawed and very biased towards the recent history. The reduction in yield calculation is not perfect. And initially, most of the issuers were using automatic translation tools to produce the text, which obviously made the text now impossible to understand.
Yeah.
that has improved and that's changed. So now the standard texts are actually quite good. But I had an incident just before Christmas. I sent out a proposal and I got the client on the phone back, and he said, well, hey, this global rates fund that you have suggested, the reduction in yield if I sell it after 1 year is -6, and that's the return potential is below that.
Yeah.
And I had to actually look into it, and it turns out, because the fund company allows you to charge a 5% commission, that's also in the kit. Now, I don't think anyone any longer charges 5% commission on a fund. But that's still in there. So it's not a perfect document. I wish it could be, and maybe we'll get there. But that's the kid. Not perfect as yet. SRI is I think quite helpful. It's good that we have something. We now have a scale that can be used across all the product types. To use it, you have to have some understanding of how it's calculated and how it works. I mean, it's obviously a fairly blunt tool still, but it's useful, and you can have a more or less intelligent discussion with the client around the concept of risk using that scale.
Well, one thing, right, is because our audience is across the globe, from the US, France, UK, even people in Singapore listen to the podcast. Is, Michael, what do you say to those people? What makes the Swedish structured product market unique, or what are their main characteristics?
Sweden as a country, we've been known to be early adopters of a variety of things. So we know a lot of tech companies, fashion companies, they try out their new products in Sweden because people are open to try new things. And I think that's very true for the structured products industry as well. We were quite early with starting capital protection. I mean, it was introduced with the big banks early 90s. Yeah. Very quickly, when capital protection became difficult to do, we took on autocallables, worst of structures, tranched CLNs. We've tried everything. So I think that's one unique aspect. Mm-hmm. Other than that, I think quite early on, we had a number of specialized firms doing only structured products. Garantum was one of the early ones. Now, we've broadened our offering, so we're now basically doing everything. But we had a number of these specialized vendors, and that kept the industry going through the tough times. Mm-hmm. When a lot of people thought it was, perhaps too difficult, or they found other opportunities and ventured into those. We had this core, if you like, of specialist boutiques that just kept everything going. They didn't have that in Norway, and in Norway, the industry was obliterated. But rebuilding it again, so it's come back, but it took a number of years to reintroduce the product.
Yeah, but I think it's important to highlight, right, the Norwegian market was kind of different, especially before 2008 they were selling these structured products connected to loans, right? It's
was very different
to leverage, right? It was completely different from the Swedish market, which is an investment product rather.
Basically they took the capital protected product and turned it into a warrant.
Correct. Yeah.
Through borrowing and leverage.
Yeah. Do you see, Demar, you were saying how you have a lot of capital protected, and then at the moment now yield enhancement, yield focused products. Do you see a shift in mentality between those two, or has there been a shift in mentality in the past between those two kind of structures?
There have been shifts, and I think now that the shift is away from yield enhancement, and we can talk in more detail about the reasons for that. I mean, the obvious explanation is that we have rates again, and capital protection actually looks good, but we can move into that immediately. Now I think we have overused the worst of structures in Sweden. Mm-hmm. It worked extremely well for a long period of time, from 2008 to 2021, but post 2021 we have seen the big companies on the Stockholm Stock Exchange dispersing widely. I mean, we have never seen anything like it. So obviously those worst of structures have been hit by that. It's been death by dispersion, basically. Now there's still, they can still recover. I mean, both advisors, managers and clients alike have become much more hesitant because we've now seen in a market environment like this, we looked at this, and since 2021, if you look at the Stockholm All Share, about 70% of stocks are down. More than 40% are down more than 50%. It's a fairly, it's an extreme environment, and obviously that's not where a worst of structure is going to perform.
But that's a very good point, right? Because what I've seen in terms of trend, right? Everyone is going to the same underlying, same exposure, especially U.S. stocks, U.S. indices, some of the European, and in Sweden again, the Swedish equity index was the top one. There was then a diversification, but what's your view in terms of how do you give exposure via structured products? Is it still very local, domestic, and is it worth it, or you see it more as a way to diversify it outside the?
Very good question. I mean, what we've found is that home bias is extremely strong. It's very difficult to work against it.
Yeah, that's true.
So it's much easier to sell something that's based on a Swedish underlying in Sweden, a Norwegian underlying in Norway, Finnish underlying in Finland.
Yeah.
So I think what we've perhaps been a little too keen at single stock baskets, and I think going back to investor expectations, because when the autocalls were introduced in 2008, volatility was extremely high. You were selling volatility. You were getting huge headline coupons. You do OMX and you get 20% per year. You do RDX, which was popular back then, the Russian index, you get 40% per year. And then obviously you anchor the expectations in that kind of headline coupon. Now you need to produce something that could come close, and that's when single stock baskets were introduced. They worked very well for many years, but now they don't. Look at the UK, for instance. I mean, most of the autocalls have been based on indices, right? So
the IFA market is 95% just FTSE.
Yeah. So, and that over the past 5 years, I mean, that's been fantastic compared to worst ofs where you get very old nice Swedish industrial companies like Electrolux tanking 80%. Unexpected, but we all knew it could happen.
Yeah, Michael, there is a bias, right? And I've studied this. I've done a lot of research on this. I even did behavioral courses to study this, and I did study both. A lot of analysis on data, and there is a bias from investors to reinvest at the same coupon, the same headline rates, which makes your life more difficult, right? Especially when you mentioned, well, you can get the same coupon here, but you're taking more risk. How do you handle that, or it's not really possible?
I think it doesn't. You need to handle it, and you need to be, an educator vis-a-vis the client, because terms change, and they change radically when market conditions change radically. And that's not always obvious for the client. Very good examples, going back just 20 years, we have several crises and a lot of different market environments that we can use to exemplify. And this structure works very well here, but it doesn't work so well in this type of environment.
Mm-hmm.
We believe the next 3 to 5 years will be, similar to this. So that's why we should be doing this. It's almost taking them to school and explaining these things. It's not that difficult once you have the charts and the data. It will be easy for them to connect the dots.
Do you feel like the education relies on the distributor to give to the end user, or do you feel like there is something that needs to be put in place to help push that up?
No, that's basically a question of whose responsibility it is to educate the client.
Mm-hmm.
I would say it's always, as an advisor and as a manager, I would say it's my responsibility. But I can obviously draw on a number of resources to get that done. Broadening that discussion, schools have a role. People come out of schools not understanding basic financial concepts and not having a clue about how the economy works. We need to do more of that, do more early on. Authorities have a responsibility. Media, it's difficult for journalists, but a lot of journalists are quite knowledgeable. But sometimes they fall into the trap of just making things, exaggerating and simplifying.
Yeah.
Which also doesn't help. But in the end, if I have a client that I'm going to help with these things, I need to know that they understand. But I don't have to explain every single technical aspect. What they need to understand is what the idea of the portfolio is, what the separate parts of the portfolio will do to contribute. And it also depends. Some people are so not interested in this, and that's why they come to me. And they don't even want to learn. They just want to feel that they can trust me. And after a while, we have a track record, right? So they know if they could trust me or not. But initially, they need to just feel that trust. And if they're not interested, that they're not, in a position where they want to learn, they should still be given advice. And that's difficult after MiFID 1 and 2. How far do you need to bring the client in terms of understanding the product? I've interviewed people who've just come out of business school and they cannot explain to me why a stock is trading at a certain price. They come up with things like, well, it's supply and demand. Yeah, that's true. But, and they have no clue of how things are valued. So it's a big step for someone who's, they've been an entrepreneur in ventilation or real estate, and they're not interested in the financial markets at all. They obviously have a very keen understanding of, risk, reward, how business works, but they don't want to learn. So
Michael, I'm going to almost ask for free advice. So imagine if I'm a new client and I have $2 million that I need to save, right, for the next 5 years. What type of proposals or advice, very high level, would you give to me, taking into account the current environment, right, for 2026?
Well, I would need some more information there, Tiago. Let's say we have 5 years. Are you risk averse or are you a Norwegian?
I would say mid risk. I don't care about the next 5 years. I don't need the cash. I'm willing to take some risk in order to raise that capital from 2 million, let's say, to close to 2.5, between 2.5 and 3 million in 5 years, right? Because I will need to buy, let's say, big villa in south of Europe. So what would you give?
Yeah. So what you're saying is that you're aiming for a return potential of 5-6% per year. You're somewhere, in the middle of the risk scale. Mm-hmm. Okay. Very, very broad picture. I think we will take the majority of that money and put it into something that's related to the stock market. Mm-hmm. And I would use index-linked capital protected notes. Mm-hmm. And we would also that would be a staple of that portfolio with the preferences that you have described. I will also use some funds in there just to get the diversification. It's not easy, just off the cuff to be very precise. I think we would end up with something as boring as a 60-40, maybe 70-30 mm-hmm. between stocks and bonds. And then how much of that exposure would be structured products and not would be, that would be a detailed discussion further on.
Okay. Just interesting. Just wanted to know exactly how you're thinking. So, Michael, you've been in this industry for close to 25 years, and of course we've seen the ups and downs of the Swedish structured product market. You mentioned about how diversified it used to be, still is, right? With credit-linked notes, autocallables, capital protected products. So, what do you think will make the Swedish structured product market stronger in the next 5 years?
Yeah, what would make it stronger in the next 5 years? I mean, to some extent, it's going to be a function of interest rates, because the capital guaranteed product is such an important driver of volume. I mean, that's a bit of a cop out as well. Other than that, I think if we keep doing what we're doing, we'll be in a much better position in 5 years from now. For the past 7 years, we've been struggling with MiFID II, PRIPS, and all the rest of it, but now we have a regulatory framework that's pretty much set. We've developed models. We know what we can do, what we cannot do, which means that we can focus much more on the commercial aspects of developing the business. I mean, everything has been tied to the regulatory side for many, many years. But we're now seeing the light at the end of that tunnel. And I think we're also seeing the banks returning to this space. We're seeing them recruit people. And we've had a trend for many years where desks are being closed down. People who are very, very good at structuring, packaging these products have moved into other areas. So we've lost a lot of competence and a lot of knowledge. But that's also coming back. So I think the trend right now is positive.
Yeah, no, I completely agree. Which is the reason why I kind of forced the WST and the SPI European event to be in Sweden, in Stockholm, in May, because I think it's a good momentum for the Swedish market, and I think it will be good to show up the strength of the Nordics market as well bring all the European manufacturers, European distributors to see, because like as you said before, like the Swedish structured product market is the one it's more keen into innovation, is willing to try new things to give the return.
But is that still true though, Tiago? Because I mean the market, I mean the Swedish market was a stellar example of how to develop structured products up until a few years ago, and now it feels like we're in a bit of we've stagnated a little bit, and maybe we have a lot to learn from others who've moved on.
Yeah, that's a very good point. So I think different markets developed in different ways, right? For example, the private banking, the Swiss market, even the UK private banking market, they moved into RFP, RFQ, purely same products, same autocallables, reverse convertibles, participation products. So, and actually, you mentioned about, for example, the UK market being only a FTSE. That's only true for the advisor market. For the private banks, no. The advisors, the wealth managers have access to thousands of different underlyings, and they're trading every day with the best price. And I think I wouldn't say that's very innovative, right? It became a product that is being, people just changed the underlying and the barrier and the potential of the headline rate. But it's very fixed. I think what we've seen in the French markets, more the autocallables, and the Italian markets, that where there is some innovation in terms of the underlyings. But I still think that the Swedish market is willing to try new things compared with other ones. Definitely the market shrunk. I mean, you used to sell 10 billion euros, like 8 years ago, right? Michael, now it sells less than 3, probably slightly higher now. It's growing, but I think you see that difference. But in terms of size, and especially players which are very focused on structured products, Garantum, Strivo, and other ones, I think those are still innovative, right? They need to be. So yeah, I agree with you. The size is much less, but I think the culture, the Swedish market is still there. And I think, we're doing this when we wanted to get your opinion too on this podcast, because manufacturers are looking into the Swedish market and coming back, and include, of course, the banks, the local banks who actually now find out that actually they lost, because they used to have an industry. They used to have diversification, and their wealth clients are moving to other wealth firms, global wealth firms, that offer more products, that offer structured products. And I think the Swedish banks and the Swedish distributors will need to be innovative if they don't want to lose their clients to let's say the international wealth managers.
Yeah, I mean that's a big divide. You know, all the international providers are still doing this, and they've become better at it, whereas the Swedish banks left it behind. I understand the wish to move to things that can easily be standardized and automated and digitized, but in the end, it's a personal relationship between the advisor and the client. And one of the fantastic things about structured products is that you have natural points in time where you need to talk to the client about certain things that are happening. Whereas if you do, a fund or discretionary management of stocks, there is no such natural point in time. You can obviously just book the client, once per quarter or whatever, but you won't have that much to talk about. Here that, okay, there's possibility for a coupon on April 2nd. Let's talk later that week. And you have something to talk about. So yeah. I think that's an aspect that shouldn't be ignored.
It's a very, very, very good point. I had a conversation with an advisor in Canada, in Calgary, middle of nowhere, in Canada, and she was saying how she got a new client, a wealth client, to invest very small in structured products. But then, whenever there was a coupon being paid, she would pick up the phone, call the client, say, here you go, you got the coupon. And the client got more and more interested and started to invest more and more in structured products because of those conversations and that experience.
I mean, it's very common. We call them coupon addicts. So it's very easy to just become hooked. It really is. But one thing I was going to ask you was that on the technological side, a few years back, everything was pointing towards click and trade.
Yeah.
And I mean, our view was that, okay, the things we do and the things that are expected and demanded from the client side right now are too advanced to do with click and trade. So we more or less left that and moved on with what we'd always done. But to me, it's always been obvious that, things are going to change in the value chain. And what's going on there now? Because I guess Switzerland and the US and perhaps Asia are far ahead.
Even Europe, I mean, yes, I think it's interesting. People thought that technology would change the industry, would replace distributors and brokers and wealth managers. And ultimately, I think I was right, or I was lucky to be right, which my view was always that technology would make the product cheaper, would make it more transparent, and would free the advisors and the distributors to sell more and to find new clients. And I think that's what we've seen. That technology didn't increase the pie, no one besides a couple of people like you, me, or some of the most big clients of structured products, no one wakes up in the morning and say, I want to buy a structured product. Right? No, it's a tool. It's a tool for advisors. So I think technology is helping to streamline. And I think you also had these platforms who were charging very high fees and kind of almost replaced the distributors, and their fees are coming down, or you have this consolidation of platforms, because ultimately they are a cost, and it only works if they are that you can help distributors and manufacturers to scale. And I think that's what we've seen now. Platforms try it. I think now they're seeing that they need to be cost efficient. They need to provide the tools for distributors. And I think that's what is happening is in the US, in Europe, in Asia, it's freeing the advisor with the tools to help the clients. So it's quite exciting because I think we're only at the beginning of that journey, as you said, Michael, right? Because especially in Europe, in the retail market, in the independent advisor space, these platforms are just beginning. Same way as the big retail banks. They don't have these tools and they will need it. But I think the trick will be, cost efficient that adds value for the advisors. I think that's going to be the trick.
I mean, that could well be, a potential revolution, because if you, what we're competing with now is passive investments like ETFs, where beta is more or less free, right? So if I'm, what kind of value am I adding to defend this type of cost to the client compared to if they just went to an online brokerage and bought the ETF? So we need to become more cost efficient, and clients are more likely today to question fee structures and ask me, this is what I'm paying, exactly what value are you adding? So and it's an interesting situation because volumes are down, which means that profitability is down. We need to turn this around and focus on making this a volume business again. And the only way it's going to be a volume business is if we can actually find a way to distribute it at a lower price. So that's a challenge.
Totally correct. And I think we talked about this, right, Michael? Last time we met a few months ago, we even like in the US, there is around 1,800 products available every day for US investors. That's a scale. Okay, US market is much bigger, but number of advisors using structured products is not that big. So there is such diversification of products available to buy and to choose from, right? That there is extra value. There is extra value into it. And that makes your life easier, doesn't it? If you have more choices.
Yeah, absolutely.
Okay, I think I have one more question from my side, if that's okay. Just, we keep saying that you've had 25 years in the industry, which is, for me, a lot of my life. What advice would you give to somebody that's kind of younger in the industry to push themselves forward, or somebody new joining into the Swedish kind of side of the structured products world?
Interesting question, I think. Well, first thing I would say is the best way to take care of your own career is to take care of the people around you. Take care of your clients first and foremost. Take care of your colleagues, even your competitors, actually, because competition was driving the whole ecosystem forward and driving those improvements. So rather than treating them as the enemy, think about how you together can develop this space. That's one. Other than that, this may be a little radical, but sometimes it's just just try to do the right thing, even if it's not necessarily super beneficial to yourself here and now. Long term, you will preserve your name and it will help you going forward. And lastly, try to be good at what you do. That takes a lot of effort, and it takes a lot of reading and being teachable, staying humble, understanding that your personal perspective is always limited, and you can listen to others because they may have seen something that you missed. So that's also quite difficult advice I'm giving now, but I think it's useful.
Yeah, definitely. Thank you. Appreciate that.
Okay, thank you, Michael, and thank you for everyone for listening to this podcast. And don't forget to subscribe and to follow us, because we have much more episodes coming.
Thank you so much, Michael. Really appreciate it.
Well, thank you. My pleasure.